Okay, here's my presentation on inflation and energy prices in the USA. What we're looking at is the correlation of CPI inflation with energy prices and its potential use to forecast future inflation trends, and particularly the possibility of using the US WTIC oil price to achieve that. Okay, CPI inflation in the USA is published by the Bureau of Labour Statistics every month. The CPIU All Items Index is what's known as headline inflation. It's a year-over-year price change. It's for all urban consumers and for all goods and services. Now, this CPI has various components which each has a weighting. Typical weightings are food 14%, energy 7%, commodities and apparel, other durable goods 19%, and services, medicine, shelter, rents, etc. approximately 60% of that index. There's also a core CPI, and that's the CPIU minus food and energy. That's less volatile, but it seems to be less relevant to consumers because it doesn't include food and energy. And it's really meant to show the degree of underlying inflation. And we're not actually going to consider the core CPI here because it's been almost constant at 1.7% over the last couple of years. Okay, here's the CPI urban consumers graph. As you can see, the CPI was about 1.5%, about 1.7% back towards late 2014 in September, and it suddenly plummeted down below zero to minus 0.1 in January of 2015, and then it stayed between minus 0.2 in April, which was the low, and about plus 0.2 for that period of the first half of 2015. And it gradually began to climb to approximately 1% throughout the first half of 2016, and we've since seen an uptrend towards the end of 2016, and really want to know where this is going to go and why it's changed. Why have we had this bout of so-called deflation? And that has resulted in the negative interest rates that we've seen in Europe and places like that, and of course a continuation of practically zero interest rates in the United States. The central bankers have used this deflation as an excuse for saying, well, the economy has not been doing so brilliantly, there are credit risks, and we need to keep interest rates incredibly low. Okay, so what could the causes for this be? Well, late 2014 headline CPI was about 2% and falling. It dipped to 0.2% in 2015, gradually rose into 2016. Why? Well, if you look at the core CPI, it actually hardly changed in this period, so I'm not even going to show it. It stayed about 1.6 to 1.7% during this entire period. Services inflation, which has been mentioned by Peter Buckvar in his interviews on King World News several times since last year, has been consistent at 2.5 to 3%. So there's constant inflation in services which include medical services, rentals, and just about any other service you can think of, and they contribute about 60% to inflation. So 60%, that has a 60% weighting in the inflation index, which means that inflation is always going to be about 1.6% or 1.8% due to the inflation in services. So there must be another cause for the variation in the headline inflation that we see. Okay, how about energy prices? Well, over the last 3 years we saw a plummet in oil prices from mid-2014 at $107 a barrel to early 2015 when the oil price was about low 40s. And then we saw a bit of a rally in mid-2015 into the low 60s, and then we've seen another fall, two falls actually, to a low of $26 in February of 2016. Now of course you really need to look at the year-over-year oil price changes, which I've marked here, and you can see some very steep falls year over year, and these coincide with low values of CPI. Okay, the CPI here in late 2014 was 0.8, it fell to minus 0.2 in early 2015, and then here, even though there was a rally in oil, it's still being compared to very high prices here. So there's a big year-over-year fall in oil, and that's still resulting in plus 0.2 inflation, almost zero. And here again in August to September, where oil hit another low, year-over-year figures, very big fall, 0 to 0.2% inflation. Again, almost into deflationary territory for this whole time. And then, as you're coming into early 2016, you actually got the low in oil prices, but the fall wasn't quite as steep. We're actually seeing a little bit of inflation here, inflation around about 0.9% to 1% in February and March of 2016. If we look at this a little bit closer, we see that later in 2016 this fall in oil prices reverses to a rise, and the year-over-year figures just start to turn positive. So in September of 2016 it's almost flat compared to a year before, and in October it's slightly up, and that means that you're likely to see a considerable increase in inflation, especially as you go forward, because the year-over-year figures are going to start to be steeply positive. And indeed, here we are in February 2017, the year-over-year change in the oil price, actually from the low to the high, is about 100%. But if you take the monthly averages, it's about 70% increase in oil prices between February this year and February 2016. What's that going to do to inflation? Well, it's going to make it rise, and it's probably going to make it rise well above 2%. What I decided to look at was the actual correlation between the energy data, which is actually present in the CPI indexes on the BLS website, on the Bureau of Labour Statistics in America, and compare them to the inflation data to see if the energy component really is well correlated. And here is the result. Okay, from mid 2015 to late 2016, a very, very close correlation between three models. The best one actually is the red model. So inflation CPI is in blue. The red model is the energy component, the energy change that's quoted in the CPI data, multiplied by its weighting, which is 0.07. And you get an excellent correlation there, which is actually about a 0.97 correlation. So that indicates that perhaps in the future we can use energy prices and their trend to look at inflation. CPI inflation is almost entirely dependent on energy sector price changes year over year. It also shows a good qualitative correlation to the WTIC oil price change. Services inflation is already 3%. That actually contributes about 1.8% to the overall inflation figure, because the weighting is 0.6. When oil and energy year over year prices turns sharply up, inflation looks like it's going to increase substantially. So I predict a CPI inflation spike is possible in early 2017 in the USA and perhaps worldwide. And I'm also looking at the moment now at the possibility of using the current oil price action to forecast future inflation figures, because there's going to be a delay between the oil price and its filtering through into the economy. And we've actually seen a very steep oil price rise going into January and February this year, which is why I'm looking at the possibility that we're going to see an inflation spike. And I'm trying to quantify this at the moment, and that's my next presentation. Pardon me. This is going to be an unedited video, so that's cough's going to be in there. My next presentation is going to deal with that possibility. I actually have a report out which is priced at the princely sum of $10, which describes all this work in great detail. And I'll be very pleased if you'll purchase that report from my website, which is linked from this YouTube video. Thank you very much, and goodbye.